Welcome back. Well, the market's a little bit lower. That's the headline index, but the mid-cap index still doing a relative outperformance, trading more or less flattish as we speak. But let's get straight to our next management. Bajaj Electricals, that's the next corporate on our radar. Remember, the company has a high amount of exposure to rural India, twice their competitors. Now, in a move to push premiumization, that's what's going to help their margins going ahead. To discuss the outlook and to understand how business is shaping up, we're joined by Mr. Anuj Poddar, the Managing Director and Chief Executive Officer at the company. Hi, Anuj. Always good speaking to you. Thanks so much for joining in. Well, I recall the last chat that we had. You were telling us about your rural exposure, but you also believe that we are on the cusp of a turnaround in the rural market, going by the data points that we had. Is that happening? We spoke a month or so ago. Are we headed towards a rural economy recovery? If you could tell us how you're seeing evidence on ground.
Yes. Good morning. Thanks for having me. Firstly, let me start with wishing you and the CNBC team on your 23 years completion. That's a long time, right? But as Bajaj, I'll just say we have a little longer history to that. Yeah. Coming straight to your question on the rural, I think we are a little time away. And for us, what we're clearly watching very closely is the FMCG space and all the commentary from that. I think they will be the first litmus test for the bounce back of the rural economy. Just last week, we were in a CII council session tracking some of the primary data on this. I think we're starting to see the early, the input data in terms of the crop sowing, some of the economic indicators there, but that has yet to translate to real demand or purchasing happening in the rural segment.
Mr. Poddar, hi, good morning. By when do you start to see, in a typical kind of cycle, by when do you start to see the full impact of the sowing and Rabi crop impact coming through? I mean, do you have to wait all the way till Jan? Yeah.
No, so I think it's not just a crop sowing, but just coming back of, we are coming in from a high inflation environment. So as that starts to stabilize, which I think it is, and as people start seeing more cash available to start spending, so I think there is a little time to go. I think Jan is a little early. We may be a quarter out to start seeing that actual purchasing at least come into our sector. And that's why I said the first indicator I really look for is the FMCG. Are they starting to see volume traction in the sabun, tail, shampoo, etc.? That will be a good indicator for us.
Anuj, hi, good morning, and thank you for your message on our 23rd anniversary. Thanks a lot, appreciate it. Wanted your thoughts a little bit on the export growth as well, because I was reading a report which suggested that from 2% of your total business, which exports is hardly anything now, you plan to grow it to 10 to 15% by 2030, and over the next 3 to 5 years, about more than 5%. How is the situation now in terms of exports, and what's the kind of annual run rate that you're looking at?
So Sonia, I always separate the current tactical or environmental issues from the long-term strategic directional sense. Last 2 years, we've had good traction. We were, about 40 odd crores. We crossed about 75 crores last year. This year, our target was about 125 crores. That said, this year has been difficult because of the geopolitical issues and the currency devaluation, not so much in India, which would help us, but currency devaluation in most other export markets of ours was a little. But that's what I put in the bucket of tactical short-term issues there. I think strategically long-term, we are looking at exports as a growth area for us. And that's why that guidance, that 2% should go up to 5% and go all the way up to about 10% by 2030. What we're using this period for is really expanding our relationships in terms of channels or distribution relationships across some of these markets, so that as and when the markets start to bounce back in terms of purchasing, we're well entrenched there. And long-term directionally, while today it seems like a very small amount, as we focus on growth there, it should start becoming a more meaningful revenue stream for us over the next 3 to 5 to 7 years.
Okay, all right. Anuj, let's focus on the fans division. And you have been speaking about premiumization numerous times. I believe premium fans as a percentage of your sales has moved to the high teens. They used to be in the mid-single digits. So as a contribution of your total revenue, where do you see this number headed? That's premium fans. And also give us an updated number about your market share in the fans division.
Yeah, so, in terms of our contribution from premium fans, it used to be very low at about 6%. Yes. Today, that's up to about 19%. So that's really a reflection of how we've been focusing on that segment based on new product launching, etc. I don't have a particular number, but let's say that 19% hopefully should go up to 30% in a couple of years if out of Bazaar, I guess, at that point. But that directionally, that is what we want to do. Start having a more optimal product mix in fans and across the board as a brand. We can talk about that from a brand journey also that we're looking at.
Okay.
Going forward, in terms of our own market share in the category, we focus on rank because the market shares tend to be slightly inaccurate. We used to be a number 6, number 7 player. Today we are close to a top 4 player. And over the next couple of years, we would expect to continue to increase our rank in the fans category.
So overall, what would this mean for your revenue growth? In the first half of the year, you've done a little under 2,500 crores, which is a growth of 14%. For the second half, what are you targeting?
Sonia, I heard Rajesh mention in the previous session about your ability to ask us these probing questions, right? No, so I don't have a particular number to put out. It does depend on the market dynamics. But we're very focused in this Q3 and Q4 also on looking at our margins. So, while the top line is a function of many aspects in the market demand offtake, we are coming in from a low margin environment. But that is something you will see, hopefully, good growth for the next couple of quarters.
So when you say good growth in margins, I mean, you're still at sort of high single digits, around 7-8%. Is there a possibility of getting back to double digits now that raw material prices have come off?
So I think double digits we'll have to wait for about 18 months. Okay. We should keep expanding our margin. Therefore, on an absolute basis, hopefully we should grow our margins.
Okay, all right. And final question, that timeline for the demerger, Q4, right? Sometime in February that should take shape?
That's right. So we've just received our SEBI NOC a couple of days ago, and we're in the process of filing for NCLT. We'd expect that to happen anywhere between 3 to 4 months if it takes a little longer.
All right.
We're very much on track with that, and we are fully geared up for that.
Okay, fair enough. By the way, just to kind of tie this up, Anuj's conversation, you began by saying at a conference you were seeing FMCG companies, etc., indicating that things are picking up, looking up. That's what you started with, right? So, and that's the early indication for you.
Economic indicators are starting to look positive, and that should translate to demand for FMCG, hopefully, very soon. All
right, thank you for that, and hopefully that'll be the case. Appreciate your time here on CNBC-TV18. That's Anuj Podar at Bajaj Electricals. Well, let's move on. Let's just take a look at the market as well, which is down 73. I mean, wow, that's a large cut now, which is materialized. We were down about 30-35 points, but we're at about 18,621. Next company on our radar is MTAR Tech. I mean, the stock has seen a near 12% rally in the last 5-6 days. There's also been an approval of the PLI scheme for making drones with an outlay of 120 odd crores last week. To discuss this, we are now joined by Srinivas Reddy, Managing Director at the company. Mr. Reddy, great to have you with us here back on the channel. Appreciate your time. Good morning. Can we start with that PLI scheme, and could you walk us through what's the size of the opportunity for you?
We have not yet studied the whole thing as of now, how it's going to help MTR in this particular scheme. Probably over the next 1 week, we will look at it and see how it was going to benefit us in the long run.
But any kind of understanding on what are the incentives that you would get? What is the kind of opportunity that you would have because of this over the long run?
We should have a sizable opportunity, but again, we have applied for our defense license also, and we are expecting in the next 1 month or so, being a defense prime for Army and Navy. So once we have that, then we'll be able to highlight more on that issue.
In terms of your order book, can you tell us, I think the guidance that you had put out for FY23 end was 1,000 crores, but you've exceeded that in the first half itself. So what is the expectation for the second half? What's the order visibility like? And what do you plan to do by the end of the year?
We have already received the orders in the first half itself. We're expecting a lot more orders to come in, but I can't quantify the numbers right now. But we'll be above that 1,000 crore level by end of this year, because our second half execution is very, very strong compared to the first half.
Hi, Mr. Reddy. When we chatted earlier, you had guided for a 55 to 60% revenue growth for FY23, margins of close to around 30%, and your working capital days comes to around 200 days. Sticking by all the three?
Absolutely, yes. We are working towards that, and we'll 100% stick to our guidance.
Okay, and since your order book is looking so good and you're sounding so confident on that aspect, For FY24, what kind of a momentum are you looking at? Obviously, FY23 versus 22 is coming on a lower base. But FY24, what sort of a revenue growth guidance will you be looking at?
We're looking at a similar guidance. It's too premature, but as of now, we are looking at a similar guidance of about 50% revenue growth, even in FY24 as well.
And what is your peak revenue potential, sir? With the current gross block that you have put, the current money that you've put in current investments, your peak revenue is how much?
It doesn't really work out that way because we are in multiple segments, but we do have enough capacities to handle different segments. But we can go to much higher revenue levels with what kind of assets we have right now, gross block we have. We can even handle the next year growth as well.
Okay, so you said 50% revenue growth is what you're looking at by the end of this year, right?
I said 55 to 60%.
55 to 60%. All right, got that. You're in the clean energy segment, which is your largest chunk. You have new products as well. There's the fuel cell segment too. Can you tell us what kind of volumes, what kind of visibility do you have here?
I've said that already. I mean, in fuel cells, we are also doing various products. We're adding a lot more products as such in our product basket, which would generate revenues of about 120 to 140 crores next year. We just got qualified for that. So we're adding all such products in various segments, which are all high margin kind of products, import substitutes and things like that. So this would really help the company to move forward in terms of improving our EBITDA margins further.
Okay, so when you say improve your EBITDA margins further for FY23, I think you had said earlier that you're looking to be at 30%. You think you could get better than that?
I would still stick to 30% at this point of time because we are catching up on, we are at about 27 to 28% in the first two quarters. So second quarter being very strong, we should be able to manage that 30% EBITDA levels, what we have committed earlier.
Mr. Reddy, that sheet metal business is small, right, for you? It did only around 12 crores in the past quarter.
That's just the beginning. We have orders worth about 140 crores already received because we have just started doing the first articles. In engineering, that's what we do. So we have completed that. So now we will slowly see the ramp up moving forward.
Yes.
And here we are expecting more than 100 crores of revenues kicking in from sheet metal itself.
So from around 12 crores per quarter that we saw in the past quarter, by quarter 4, do you think we'll be at a run rate of around 25 crores per quarter?
Not really. We would still maintain that because there are a lot of first articles and batch productions going on in this quarter and the next quarter as well. But next year, we would look at more than 100 crores of revenues kicking in from sheet metal.
Okay.
Okay. All right. Thank you so much, Mr. Reddy, for stopping by, and appreciate all the numbers that you shared with us about the business and how things look way forward. That's MTAR Tech, very confident. Second half will be better than the first half. A 55 to 60% top line growth is what they're looking at, and holding on to the margin guidance of 30%. The market, by the way, the Sensex is down about 0.5%. Some selling pressure over there. Perhaps I should have just stayed on leave. The rally was so good. Great for the bulls, great for me.
No, we like you back, Sonia. But good try, right? Okay, the market is down 90 points as well. So this is at the low point of the day. Just a few other names. Mitesh is with us to run us through what he would do. Gujarat Fluorochem, we should put the stock up. It's down 4%. It's coming up with very large volumes, 3,300 on Fluorochem. Adani Enterprises is coming up. So new names in the mix, 2.5% higher on Adani Enterprises. BHEL, which went up on Friday, that's seeing some pullbacks and a 3% cut. Zomato is down about 3.5%, 4%. TVS Motor is down about 3%. And of course, I mean, some of the other ones like Angel is down a full 4%, and Persistent is down about 2.33% as well. I have to say, market breadth is still 2:1 in favor of advances, even though the Nifty has come off quite sharply. This could turn out to be a session like what we saw on Friday, where the index was lower, but broader markets were doing just fine. Mitesh Thakkar is with us with some trading ideas and how he would see this decline now, and if he wants you to do something. Mitesh, hi, morning, welcome back. What's your sense, and what would you want to do?
Morning, Prashant. Early in the day, I was talking about the fact that we could see a bit deeper cut in case we start trading below 18,650, and maybe in the worst case, 18,450, 500 zone could be tested. I think that's where we might head. And so not in a hurry to buy the index, but on stock side, still trading with long bias. UBL is something which has caught my radar today. That's a buy with a stop below levels of 1730 for targets of around 1785. And Tata Steel is the other one, which is given a weekly gap up and a continuation. So disclaimer, we have some options, call option positions over here. Tata Steel is a buy with a stop below 112.5 for targets of 120.
Okay, Tata Steel is actually having a pretty decent run this morning. It's one of the biggest Nifty gainers right now, up 2.5%, and it has Hindalco for company up almost about 3% Metals are doing exceptionally well, bucking the trend entirely this morning. By the way, Reliance is dragging its feet and dragging the market overall, so do keep your eye out on that. Let's slip into a quick break. On the other side, we'll talk about the commodity markets. Manisha Gupta will be with us. Stay tuned. It's a 100-point cut that we're seeing on the Nifty. The Bank Nifty is down over 100 points as well. So let's just take a breather from tracking the equity markets and shift focus to commodities. Manisha is here to tell us more about that. Manisha, good morning. What are you looking at?
Morning, Sonia. I'm looking at crude oil prices because so much happened over the weekend and more expected during the day today. But look at the prices because we've seen 5% of gains in the previous week and we've started the day on a very positive note yet again. So 86 holding for the Brent and 80 to 81 is how we're looking at the WTI crude oil prices also. Well, OPEC over the weekend has delivered on what they decided in the OPEC and allies meeting, and they said that the production will be unchanged. So what they had decided in the November meeting, that 2 million barrels per day of a cut is what they are looking at in November, and that would go through into 2023 is what the markets are sticking on with right now. But remember, OPEC will continue to come and talk about various things, especially as the street readies itself. You have the price cap coming into action today. We have seen that come in from the European Union and G7, and various other countries seem to be supporting it as well. So that comes in force from today. As of now, we do understand that the Russian Urals are trading at around $66 per barrel, and the G7 has agreed to impose the price cap at around $60 per barrel there. This is going to be enforced also by G7 and Australia, apart from the European Union, 27 countries there. And the whole deal around this is that this is going to be reviewed every 2 months. So now the next review really comes in for the month of January. What they have also decided is that they will keep the price cap 5% below the market price. So that is exactly how it's working right now. But what you have to watch out for is that there is also coming in an embargo on imports of Russia crude by sea. This is what European Union also is putting in force today. The European Union also has said that on 5th of Feb, not just crude oil, but the crude oil products, petroleum products as well, is something that will completely embargo on. So as of now, we do understand that US, Canada, Japan, Britain also have plus sanctions on Russian crude by sea. All of that comes into impact starting today as well. Russia, in the meanwhile, has said that they will not accept the cap, but will cut production to all of these countries going forward. We still are awaiting a formal notification from Russia onto that there. This is what exactly said. The European Union, while they have cut Russian crude products, Russian crude oil from today, on 5th of Feb, they will cut the Russian petroleum products as well. So the sanctions will only get stringent as we move forward from here. But the crude oil prices as of now also taking support from the COVID curbs easing in China. That seems to be supporting demand as well. And when you look at the next year outlook, whether it's from Citi, Bank of America, Credit Suisse, they all are looking at higher crude oil prices going forward. Anywhere between $96 to $110 per barrel of an average price is what many of these brokerages are forecasting.
All right, Manisha, thanks very much for that. So China and commodities, I mean, interlinked in more than one way. So that's interesting. Just a few other names. Karnataka Bank is up 7.5%. Again, these are newer names. As I said, market breadth is still positive, although the gap is narrowing. Karnataka Bank is a very strong one. And the other one is MedPlus, which is, of course, the physical pharmacy chain, the second largest in the country. That is up 7.5% as well. So these are both these names coming up with very strong volumes at this point in the day. Angel One is what we spoke about. They've sort of put out a business update for the month of November. Stocks down. Surabhi is here with details. Surabhi.
Angel One has released their November business update, and it's a weak set of numbers. Their gross client acquisition was down in third consecutive month. It was down 6% on a month-on-month basis. Their number of orders were marginally up, but this is mainly because there were higher number of trading days this month compared to the previous. They have seen a significant drop in the client funding book as well. The client funding book was down 18% on a month-on-month basis at 1292 crores versus 1575 crores in the previous month. It has lost market shares across all segments, F&O, equity, cash and commodity. First time in 7 months, it has lost market share in the commodities segment. It is down 210 basis points at 51.3% versus 53.4% in the previous month.
All right, Surabhi, thanks a lot for that. Well, Persistent Systems is the other stock on our radar after JP Morgan downgraded the company. Remember, Nimesh, our colleague, had highlighted that Persistent Systems was a stock on his radar when JP Morgan had upgraded the stock in October. What led to a downgrade in less than a month? Nimesh is here to tell us about that. Nimesh.
Hi, Sonia. So what led to the downgrade is the fact that after that upgrade in October, the stock has slided 31% versus the IT index, which is up only 14%. So there has been a big outperformance on the stock in the last 2 months since the last upgrade. And now JP Morgan believes after a 31% rally, the stock is fairly valued at 32 times 1 year forward price to earnings. And it is trading at a premium to all the global peers. In fact, the quarter 3 could be a surprise, and that's something they'll be watching out for. But in case there is no big surprise in the quarter 3 earnings, they do not see any positive catalyst that can drive the further re-rating. So after a 31% rally and the stock is fairly valued now, JP Morgan has gone ahead and downgrade the stock again to neutral from overweight, and they've written a target price of 4,100 on Persistent Systems.
All right, Nimesh, thank you very much. That's a big run, and there's a downgrade now coming through as well. We'll take a very quick break here. On the other side, our special broadcast, Citizens MPC, that's Monetary Policy Committee. My colleague Lata will be joined by Sonal Verma, Managing Director and Chief Economist at Nomura India. Sameeran Chakrabarti is Chief Economist for India at Citi, and former Chief Statistician Pranab Sen will also join in. Soumyakanti Ghosh, Group Chief Economic Advisor of State Bank of India, and Sajid Chinoy, Chief India Economist at JP Morgan. So that's a power-packed panel. They'll join Lata to discuss their expectations from the MPC meet that kicks off today. Stay tuned.
The Reserve Bank's Monetary Policy Committee meets on December 7th, or will at least announce its decision on December 7th on whether there is a rate hike and how much. As always, before that, we have CNBC-TV18 Citizens Monetary Policy Committee meeting to discuss what the MPC could be pondering about. Joining me are Soumyakanti Ghosh, the Chief Economic Advisor at State Bank of India, Sajid Chinoy, the Chief Economist of JP Morgan India, Sameeran Chakrabarti, the Chief Economist, Citi India, Sonal Verma, the Economist, Managing Director and Chief Economist at Nomura India, and the Chairman of our committee, the Citizens Monetary Policy Committee, Dr. Pranab Sen, former Chairman of the Statistics Commission and former Chief Statistician. Gentlemen, and Sonal, thank you very much for joining me. Sajid, let me start with you. The global backdrop up until Thursday looked benign. The non-farm payroll suddenly gives us the feeling that the Fed may hike for longer. So what's the global backdrop that we have to tackle?
Lata, this may sound very trite, but I think the only thing that's certain is uncertainty. And I'll tell you why. All of us are talking about a big slowdown in the global economy. But the fact is the data continues to be very resilient. The US economy is growing at 1.5% in the fourth quarter. You're seeing both consumption and capital goods accelerating in the fourth quarter. Now, there again, there's a dichotomy. You've got the goods sector. The PMI for November was very disappointing, and you would think that we're in some kind of goods recession around the world. But the services sector continues to be resilient. And so even though we're expecting some kind of slowdown, there is no sense yet that over the next 6 months, a global recession is imminent. Okay. The US is holding up much stronger than expected. The European recession is shallower than once feared. China is stumbling, but the fact is the global economy continues to be quite resilient. Most importantly, any global slowdown is not resulting in a softening of labor markets. Right? If you look at the NFP number that you pointed to, he has 260,000 jobs, but I think the most important number was wages last month grew at 0.6%, which is an annualized rate of 7%. Over the last 3 months, US wages are growing at 6% annualized rate. 6% wage growth in an environment of weakening productivity is not consistent with US inflation at 2%.
So what does the MPC make of this?
What it makes is you've got 3 different cross currents. Number one, global growth is going to slow. There'll be some disinflation from that India's MPC will take into account. Yes. But will global inflation slow enough for the Fed to stop at 5%? Potentially not. I think the risks now are that both the Fed and the ECB will raise rates beyond what markets are expecting. And once that begins to get priced in, you could easily flip back to an environment of a stronger dollar where EMs are under pressure. So the cross currents are slowing growth, but sticky services inflation, sticky wages, and a Fed that could keep moving beyond what we think.
What do you think, Soumya? Should we be, at the moment, I think the market is penciling in up to 5%. You think the MPC should prepare for something more, and so accordingly their stance, everything should be still kept open?
No, I think, Lata, I agree with Saji's view. I think US labor markets have been uncharacteristically strong, resilient, and it doesn't see any signs of bucking down.
Okay.
If I add to this, wage growth is annualized 7%, which is much higher than the 2% target which the Fed is. There is also another aspect of the US labor market which is going to keep it tight maybe for an extended period next year, is that there was a report recently which says that 10 million in the age group of 23 to 54 is missing from the labor force because US employers are now looking at people who are actually needs to be more skilled. So if that is happens after COVID, and so if that is the case, we are in a situation of an US labor market which is going to have a high vacancy rate, low unemployment rate. So therefore the quantum of rate hikes which the Fed was looking into, and the issue is that Fed has now committed itself to a 50 basis point rate hike, climbed down from 75 in December. Beyond December, there could be more rate hikes by the Fed. Magnitude of that could be lower than 50 or equivalent to 50, but the moot point is that it will move beyond 5. So that could actually materially change the outlook of the emerging market economies in terms of a rate hike, in terms of where do they need to stop. Because if that is the case, I think it will be difficult for the markets to absorb rates which looks now imminently higher than the terminal rate of 5%.
Okay. Well, Samiran, before I come to you, let me get Sonal in. Sonal, do you think, therefore, that the December 7th decision will have to seriously ponder what comes after? Maybe this decision is easy, but what they signal will be more important.
Yeah, Lata, I think that's exactly going to be the case. While December is, in our view, for various reasons, a step down, I think the bigger discussion this time around needs to be on the path forward. Because I think a lot of the discussion, not just globally, but also in India, is around a lot of coincident indicators like labor market, services inflation being sticky. We know for a fact that in a business cycle, the slowdown starts with the housing and the industrial sector, gradually feeds through into the labor market, and with a lag is actually going to show up into wages and services inflation. So in our view, the fact that US labor market is so sticky suggests that yes, the Fed funds rate is likely to be higher than what markets are pricing in, but also lowers the probability of a soft landing. So we do actually firmly believe that both US and Europe are headed into a recession. And therefore, the global growth outlook for 2023 is going to be significantly weaker than currently expected. And therefore, from the MPC standpoint, Lata, I think the question is, we have, of course, taken policy rates in India all the way from effectively 3.35 to 6%. We know that monetary policy works with lag. We need to therefore take into account not just the lags of domestic policy, but also the spillover from global slowdown into domestic growth and domestic inflation next year. So that's essentially, I think, the bigger question this time around, what happens next rather than what happens on 7th of December.
Okay, it gives me the feeling that Sonal believes that things will be even softer next year, and maybe the need to hike may be less. But anyway, first, Samiran, the big issue also is current account deficit. The dollar has walked away from the 114 levels significantly. Is that a lesser problem to address this time at all?
Definitely. I mean, part of the reason why we are looking at this global backdrop is the nominal interest rate differential between India and US, and to some extent we are worried that that gap is going to narrow too fast if Fed has to hike more than what markets are expecting today. If for some reason the dollar cycle turns, which obviously is connected to the Fed rate view as well, then there's a possibility that RBI might have some leeway in not hiking as much. Okay. not just because of the simple USD INR issue, but also because of two other things. One, when the dollar cycle turns, typically we see capital flows to EM improve. And the second is that optically the RBI's FX reserves numbers look to be much better. So that creates this perception in the market that RBI has more ability to intervene and stabilize the currency. So the speculative pressure on the currency also reduces. So from a financial stability standpoint, yes, a turning of the dollar cycle definitely is a positive for RBI.
Okay, so the hawkish part is that the US inflation may remain longer higher because of labor market issues. But the positive could be that the pressure on the current account deficit and, as Sonal says, possible slowdown in the global economy could weigh.
The challenge is that if Fed has to hike more, then would dollar remain weak?
Whether it goes back.
Whether it can go back up or not.
Time permitting, I'll come back to that. But we have not tackled the most important mandate for the Reserve for the MPC, which is inflation. Dr. Sen, on that, sir, do you think inflation, as per the Reserve Bank's forecast, will come down to 5.8 and to 5.2? So it's less of a problem. The Reserve Bank can signal lowering of rates because inflation is not the monster it was?
Well, Lata, I mean, one can't be entirely sanguine about that. I mean, the points that all my colleagues on the panel have been making seems to suggest that next year is going to, in fact, be a bigger challenge than this year. This year, things look much more predictable. Next year isn't. And so one has to be a little careful about this. Now, one of the things which goes in RBI's favor is the fact that the commodity prices, which actually led to our inflationary process, those have stabilized and have started to moderate. Now, even if the global economy doesn't perform as badly as people were expecting a couple of months back, I don't think commodity prices are going to go any place. If the global economy is weaker, then commodity prices may actually decline. So that makes the uncertainty even more. But on the other hand, the critical issue at the moment is the fact that the dollar has weakened, which means that the imported inflation we are getting through the exchange rate, that has moderated and probably almost gone away. Now, if the dollars actually starts getting stronger, then this process becomes even more in the favor of the RBI. And it can actually take a much more sort of softer stance, as it were. But I think we're now in a situation where RBI really needs to take a call about the decision it takes now and then go to a position where it can shift either way, because we don't know what the global economy is going to be doing. And I think we need a two-way flexibility next year.
Okay, so the stance becomes very important in that case, and the wording of the stance. But the rate decision is what is more important. I'm going to change the tack a bit. Let us vote now on the rate. Let us get our guests to vote. We will discuss the stance and the take of the MPC's take on the stance